everybody, I'm Robert Donovan. Welcome to this episode of Tradecraft Solutions. In the last few videos, we've been building this financial structure that I use for long-only and or buy-hold investing. And if you want to see the explanation of why I put it together this way, click the link to the show playlist below. As I've stated in all the previous episodes in this show, I plan to use index investing and the 4% rule as the base from which I produce passive income, to be supplemented by 3 side hustles: my consulting business, a Forex account, and later on a futures account. I chose Forex and futures as side hustles because there are 2 periods in the last century during which a severe market decline took decades to reach new highs after inflation. And this is something that I do not think the FIRE community has paid enough attention to. The periods in question are August 1929 to December 1959. This first slide shows the S&P 500 using nominal pricing. This is what it looked like adjusted for inflation. The next period in question was November of 1968 to December of 1992. First slide again shows the nominal prices for the S&P 500. Slide 2 shows the S&P 500 performance adjusted for inflation. In hindsight, on a price chart, even inflation adjusted, these declines can look fairly innocuous. It's a lot harder to actually live through periods like this, though. If I start pulling an inflation-adjusted 4% to live on when the S&P 500 is at, say, 100, and it goes up to 200 over 5 years, and then falls 50% back to 100, after inflation, I've lost money if I've been pulling money out all that time. The longer it takes to reach new highs, the higher returns I'm going to need to overcome the cumulative losses due to inflation and my annual 4% withdrawals. The sooner a severe decline happens after I start living on my 4% per year, the greater the chances that I'm going to need a second income stream. If I start just before the decline and then the decline happens, that is the worst case scenario. In the next series of slides, we're looking at an account balance of $1 million and how it would have performed adjusting the withdrawal for inflation using the 1968 to 1992 decline. Inflation always compounds against you, wiping out buying power and standard of living over long declines, unless I go back to work. A side hustle provides a supplemental income stream, but side hustles may not work as well in the economic conditions that tend to cause these kinds of long declines. This is why I like Forex and futures trading as side hustles, because they let me hedge my VTI account against stock market declines, selling short dollars in the case of the Forex, or selling short stock index futures in the case of the futures account. Both have good liquidity, low starting capital requirements, location independence so long as there's an internet connection available, and a high potential upside. Unlike futures, Forex lot sizes are variable, which allows for finer risk management, which is why I've chosen to start with Forex and not the futures account. We'll get into the nuts and bolts of all this when we get into trading. For now, let's just look at where it fits in my current financial structure. My taxable brokerage account box here, I'm going to put some more detail in. The bulk of my portfolio is currently the VTI, which is the Vanguard Total Stock Index Fund. I mentioned in an earlier video that I was also going to fund a lending club account. I have since decided to put that money into the emergency fund and concentrate on consistent Forex performance first. All accounts in the dotted line rectangles in this box are going to be added as per future developments, and I will let you know when they go live. My wage and consulting income are basically feeding my checking account, my main checking account, for living expenses and also a little bit to boost savings. The Forex account and later on the stock index futures account are both going to just directly feed the VTI account. 20% of the short trade profits are going to go directly to my VTI account, and as these accounts grow, that's going to shift to 80% of the profits go to VTI. The other 20% stays in those accounts to make them grow. That completes the financial structure that I use to manage my finances and build capital. It lends itself to a high degree of automation and is scalable. If you change the personal accounts to their business equivalents, you can use this structure for a business. The accounts can be in multiple institutions for lower fees and higher returns, or you can keep them in the same institution if you want convenience. That's pretty much it for the financial structure. So far in this series, I've rather glossed over debt reduction and credit building because I am debt-free at the moment. But since many watching this may be struggling with those very things, the next series of episodes is going to be devoted to my favorite debt reduction and credit building strategies. That, plus what we've covered so far, form a solid foundation from which to use my Forex account to start generating more income, and the videos are going to start focusing on that as soon as we get through all this. I very strongly believe you have to have this base built to have the right mindset to trade Forex. If you're constantly worried about managing all this other stuff, it's going to detract from your ability to trade well, particularly when you're using leveraged instruments like Forex or futures. That's it for this one, folks. Wanted to keep it short. Thanks a lot for watching. If you like this content and want to see more, comment, like, and subscribe. Share it around if you feel the need. Let me know if you think this or something similar to this structure might work for you. Welcome to all who have subscribed since my last video. Always glad to have you. And as always, may the balance of your day be awesome.